Hello and welcome to the Irish Life podcast series called Embracing Investments. Here we talk with key people at Irish Life Investment Managers, or ILIM for short, who share their expertise and insights on the main issues that impact on the value of people's pensions and investments. My name is David Haslam, and in this podcast I'm joined by my colleague Niall O'Leary, who is ILIM's Head of Bonds and Chief Strategist. The relentless and uncertain path of coronavirus continues to leave a trail of death and chaos in its wake. The epicenter of the outbreak may have moved away from Europe to the US and South America, but every day the total number of people either catching the virus or dying from it is rising. While Ireland has the spread of the virus under control for now, the total number of daily new cases globally is rising faster than ever. Worryingly, countries coming out of lockdown are now seeing case numbers rising again. Stock markets, however, remain confident that we are moving in the right direction and the worst is behind us. And hopefully that is the case, but my day-to-day experience is that this has impacted on people's confidence around investing, as concerns about the shorter-term effects on investments and the longer-term impact on retirement savings and pension nest eggs remains. I've invited Niall along to share his thoughts on the performance of markets to date, the trends in coronavirus global case count and the threat from a second wave, as well as how markets are interpreting the level of government support, and finally, what happens if there is a change in US president later this year. On that note, I'd like to introduce my guest. Hi, Niall.
Hi, David.
Niall, it's been a pretty crazy year so far, with coronavirus responsible for millions of people getting ill and unfortunately hundreds of thousands dying. Alongside the human tragedy of it has been the quickest and biggest fall in stock markets since records began, followed by one of the sharpest recoveries. Where are stock markets at now?
Yeah, David, thanks very much. It has been a unique period in so many respects, and that's probably best captured by the extraordinary levels of uncertainty that have been caused by the outbreak and by the spread of the coronavirus, its impact on stock markets, but also on our lives. It is not often that we witness an event that can impact so many people in so many ways and so close to home. From an investment perspective, you are right, stock markets have fallen, and they fell 32% in quick order as the market struggled to understand the virus. However, government supports, lockdowns, and other factors managed to control the spread of the virus kicked in, and we've begun to see a recovery. In fact, all told, stock markets are down now by about 6% to the end of June. But it's a volatile market, and we are seeing swings of 2 to 3% on a daily basis.
Okay, so we're not out of the woods yet. I mean, we know what caused the fall. What is driving the recovery as coronavirus remains without a vaccine for the foreseeable future?
It's a tricky one. If you look at it in terms of geography, each economy has its own story to tell. Despite accounting for over 25% of coronavirus cases worldwide and concerns over easing of lockdowns in some states, the US has benefited from a combination of support from the central bank, the Federal Reserve, very, very large spending programs by the government, and also maybe by the fact that technology stocks have been so resilient and make up such a big part of the US stock market. We have well-known companies like Amazon, Google, and Apple, for example. But the UK, by contrast, has been one of the worst performers, having been one of the last to apply a lockdown solution. There's the cloud of Brexit still lingering in the background. And there are also some signals from the government that they'd like to remove supports earlier than in other countries. Broadly speaking, I think any recovery has been a combination of governments promising a high degree of financial support, central banks indicating that they will keep interest rates low for a prolonged period of time, and the reopening of economies and signals that progress is being made towards a vaccine. If you look at it in terms of different types of investments, equities have been impacted the most and do remain in negative territory in every major economy, with the US doing best for the reasons I've already outlined. In contrast, government bonds have been more positive, albeit really in a small way. For example, year to date, Eurozone government bonds are up about 2.5%.
Right, so this is the bit that is confusing to many. I look at the new cases of coronavirus and they are reaching new highs at a time when stock markets are going up. They seem to be rising for the same basic reason that they fell in the first place. So what's going on there?
Yeah, David, it's a fair point. I believe there are some key differences, though, between the initial outbreak and where we are now. The first places to get impacted were some of the largest economies in the world, Europe, China, and most recently the US. And when these economies shut down, it had a profound impact on global growth, and as a result, stock markets reacted negatively. And as the lockdowns kicked in and the new case numbers started to stabilise, markets looked through the immediate difficulties and started to take a more long-term perspective. But the more recent drivers have been a rising case count in places like South America, whose economies have a smaller impact on global growth. However, we can't lose sight of the US, where there's been a re-acceleration in the case count, in particular in states like Texas, Arizona, and Florida, where they have been easing restrictions. So while the numbers are on the rise and the human toll is significant, the potential financial toll is lower from an impact in emerging economies like Brazil is less severe. However, if we have a material second wave of coronavirus cases in major economies, and we have those concerns right now around the US, then that could be a perfect storm, both in terms of the human toll and the financial impact. So I guess we cannot really lose sight of what the central banks of the world have been doing to try and mitigate these risks. Across the world, the central banks of the largest economies have been cutting interest rates and putting in place programs designed to ensure that in the long term, governments can pay their debts. And it's not just governments. They're also putting in place programs to reduce the risk of corporate failures so that companies don't go bankrupt. And that gives confidence to markets. Confidence to look through the immediate trauma of the impact of the virus and to think about the recovery phase.
Okay, so just to pick up a point there, is the situation in the US not still a major concern?
Yeah, David, it is. One of the key measures we look at is the widely reported number of hospitalization cases, and that number is starting to rise again in the US. It is unclear at what point some states will reach the tipping point where their health systems cannot cope. There logically would be a big focus on states like Texas, which account for almost 10% of the US economy, and where the governor has already halted the phased reopening due to the new wave of the virus. We can look at testing and the fact that it's on the rise in the country and that it is uncovering more and more cases. But at the same time, states are insisting on reopening their economies. It's definitely a situation we and other investors are watching closely.
So to your point earlier on then, is it the case that we should all simply be investing in longer term Eurozone government bonds?
Life is never that simple, David. Yes, the ECB, the European Central Bank, has committed to an unprecedented level of support and in a variety of ways. But in any environment, especially one that's as uncertain as this, it is crucial not to be exposed or overexposed to any one asset class over the longer term, no matter how attractive it might look in the shorter term. Yeah, bonds have performed really well in the uncertain environment that we've been living in recent times. But we've also seen the performance power of equities when the markets have confidence and belief. Over the shorter time periods, that can be a double-edged sword, but we know that in the long term, the trend for equity markets is upwards. So both bonds and equities bring different benefits to an investment portfolio, and any savvy investor would want to have exposure to both, and not just to equities and bonds, but also to other asset classes like property or alternatives. Each will have a different journey through times like these, and trying to pick the right one, and most dangerously, trying to combine that with trying to cherry pick it at the very best possible time. It often ends badly with investors buying high only to sell in the future at a lower price.
Yeah, I would be lying if I said I'd never tried it, but I learned my lesson and I agree with you. And the research supports the theory in terms of longer term success. Spreading risk across many investments works and it lowers volatility. And speaking of volatile, Mr. Trump is up for re-election in November, and election years are usually bumpy for stock markets, and I wouldn't expect this one to be any different. What are your thoughts on the outcome there?
I would say that the polls are the best way to consider this at the moment. At this point, polls firmly indicate that Biden is the clear favourite, with a probability of over 60% that he'll be the next president of the US. Well, I guess many would see Biden winning as a good outcome for the US. It is likely to result in a more diplomatic approach to foreign policy. Generally, markets would not be a big fan of a Biden presidency, and they would have a preference for Donald Trump. And the reason for this is because some of the measures in Biden's manifesto call for higher wealth taxes and corporation taxes, which would not be received well by the stock market. I guess ideally, a split Congress would give the Republican Party enough power to soften some of these measures. However, if Trump remains in office, there are some obvious concerns, the biggest of which is that he wouldn't face election again after 4 years, and perhaps that might free him up to pursue some of his less popular policies.
Niall, thank you. That has been a great insight into what's going on currently and what to look out for as we head into the second half of 2020. I'm taking away 3 clear messages from what you've said. The first is that stock markets are currently optimistic about economic recovery in the next 12 months, but if coronavirus case counts were to spike again in the absence of a vaccine, it could present a challenge to current stock market levels. The second is the benefit of spreading or diversifying your investment risk as much as you can. It's an essential part of smart investing for good investment outcomes. And finally, between coronavirus and the US presidential election, uncertainty is likely to remain a feature of stock markets in the short term. It's worth remembering, staying invested for the long term is more likely to deliver better outcomes. That's all from me. Thank you for your time. I hope you found this podcast useful and look forward to talking to you again soon.
Irish Life Investment Managers is part of the Irish Life Group and manages assets for Irish Life Assurance. Irish Life Investment Managers Limited is regulated by the Central Bank of Ireland. Information correct as of the 30th of June 2020.